good to have you on the BS Banking Show. Now, my first question is that if you go by the results of all banks in recent times, it seems to suggest the worst may be over behind us, the after effects of the pandemic. What is the sense that you are getting from the banking sector?
Firstly, thank you, Raghu. Happy to be on the show. Yes, it is quite encouraging to see results across the spectrum. As of now, I think all the large private sector banks have, public sector banks haven't yet come out. But I think the trend line is very clear. What most of us feared would be the consequence of the pandemic on the credit quality of banks. Happily and thankfully, that looks quite robust, which indicates that both the portfolio and the cleaning up that was done years ago has held well. Second, the very many regulatory interventions that came in to support customers through this period have also worked well. So at this point in time, my view is most of us have both provided well and dealt with the pandemic. So have customers been able to keep their record okay. Here on, I think the situation will be different, not pandemic-led challenges, but what's going to happen in the economy and where things are shaping up. But on balance, at this juncture, most of us have come out fairly unscathed with good quality provisioning and good quality portfolios. And that speaks to fair amount of work across years. It doesn't happen. Yeah, you know better than me. Credit quality is not you don't build it 1 year, right? You build it across a period of time.
You see, in the last 3 years, one variable which held in favor of the industry was the interest rate. It was pretty soft. Now that we are going in for a switchover, that's a new variable in the equation. So how do you crystal gaze?
I think that the consequence of a rate increase has to be seen through 2-3 lenses, right? One is it obviously means money is more expensive. Borrowing will become more expensive, but so will return on people's deposits. So as long as that real rate doesn't wildly fluctuate, then you can cope with challenges. And again, if the rate increase is an unprecedented, unabated, continuous growth, there are one set of actions. And if it is a sort of a correction leading up to a rate increase and it stabilizes at that level and growth happens, then I think cause for worry is less. So the jury is on kind of GDP growth that we will face in the period ahead. If we have come out of the trough and COVID-related challenges are hopefully behind us, and of course the wild card is the Russia-Ukraine situation. But if you have to discount for that and believe that that will more or less stabilize, then I do see a rate increase per se doesn't mean, bad news. What it means is that you have to readjust yourself to a higher level on both sides. And in the near term, when there's a rate increase, just when there's a rate fall, the rate borrowing rates for customers comes down graded, but cost of money is different. So I think in this period of time, you will see lending rates going up, deposit rates trailing. So the near term, banks will benefit from the rate increase period. And again, we have to see it, is it a sustained rate increase or does it start plateauing at some point in time? I think all of us have factored in the repo rate to go up by another 50, 60 basis points over the next 12 months and developing our plans around that. As long as the industry investments keep happening, which I'm hoping will spur GDP growth, will start seeing traction as we go into calendar 22, a lot will be relatively sanguine.
Can you give us a sense of the split up between the corporate and retail book in your case?
About 3 years back, we had guided that we would keep our retail. When I say retail, I mean all exposures, say below 5 crores at about 55% of the book. And above that at about 45% of the book. And as we speak today, we are really at that point, 55-45 retail wholesale. Now within retail and wholesale, it depends on the opportunity and the situation and the margin.
Now, if the stress were to continue, do you see yourself going a bit easy on the retail front, given the embedded perils in it?
See, again, I go back to the earlier points I mentioned in terms of what is driving this stress as we see it. Is it a sustained job loss, economic downturn related stress? Then certainly things will be different. But if we are seeing GDP growth happening, but at an elevated cost, then it is not as, it's not a bad news situation. So I think we have to be calibrating our plans to how things are shaping out in the economy. My own sense is the emergence of credit bureaus, uh, the various economic ecosystem developments that have happened in Chandan, Aadhaar, mobile, digital, a bunch of stuff that is happening. Nobody wants a bad credit history. Even a startup, a young executive or a young borrower doesn't want to see his records card, which is one very major development from what even 10 years back, right? All of us have seen the industry over the last 30, 40 years. I think the biggest development that has happened, particularly after the emergence of the bureau and the technologization, so to say, we've seen the eagerness, keenness to have a scratch-free credit record is very high. I mean, if for any reason somebody sees, one payment missed, you can see them scampering all around to somehow, make sure that their record doesn't take them to a score lower than, say, 700 or 720 or 730. So I think people have become highly sensitive about bureau scores, and because it impairs career borrowing record across time, it's very hard to reset your record once it goes bad. So my view is it won't get as adverse. Yes, there may be some sectors of the market which may see near-term pressure, but it's certainly not, which is why even through the pandemic, you didn't see dramatic deterioration in credit, right? It may slow down credit growth, but it will not see deterioration in credit quality.
Last year, you said simple, digital, contactless will be the cornerstone of your strategy. How do you see this shaping up?
Oh, yeah. I mean, that's a mantra we've been living to, Raghu. Thanks for pointing it out. Yes, the mantra at the bank is digital at the fore, human at the core. So everything we do should have both the elements addressed. And to make that happen is really why we chose simple, digital, contactless. Contactless became even more important in the pandemic because the need for physical, ability to connect was way lower. So all, I can go on, rattle around a few developments that we did. All our products and offerings have been designed around that. Whether you're talking of Fedi, which is our sort of chat bot, which you today can virtually do almost all of your banking requirements and all through click on your device. We've developed, designed all three principles being in place, not only just for the outside. If I turn my camera, you will not see a single paper on my desk. And it's not just because I'm doing an interview with you. I don't see paper at all. I stop totally. Everything is digital. So my office is wherever I go, wherever is, location that I am is the office, because the device is in your hand. All that we want to do, we do. Our board meetings have become digital. Of course, my pandemic initiated it. So we've tried to digitalize, so to say.
How do you see the run rate on branches shaping up?
About 6 years back, Raghu, we chose the mantra of branch light, distribution heavy, basically making, we had, I've been in this job for a fair bit of years. The first 4-5 years, we doubled our network. And then we said we must get our branches very productive before we run into developing more branches. In the interim, spend our money on digital so that we increase our distribution. That's why we came with branch light, distribution heavy. So in the last 5.5 years, we added only 25-30 branches. But we more than doubled our business because we use digital, RMs, feet on street, making our current branches more productive.
My last question to you. The government has put forward a plan for digibanks. How do you propose to utilize this window?
I think it's same. It speaks to the same theme around ensuring self-service, ensuring that capabilities for customers across the spectrum, across geographies, are heavily intuitively self-usable, right? I mean, you don't want to create a digital capability which is intimidating. You want it to be extremely intuitive and friendly for the end user, which is often in vernacular. So I think these digital banking units, we have what we call Fedi studios. We have 9 of that already across the country. We see the digital banking units that are being recommended now quite akin to that, which is like completely self-service 24/7, do it when you want, where you want, how you want, but in the confines of a branch environment or branch-like environment. The Fedi studio, which we have in Mumbai, we have in Chennai, we have in Calcutta, we have in Cochin, we have in Bangalore. and we have a few more lined up. These will be exactly what we are looking at is self-service. Virtually everything that a customer wants to do can be done. And it can be in, hopefully, which we're working on, is vernacular and doesn't need a user manual to use. That's broadly the point. I mean, if you make it too intimidating, then the idea is lost. Today, the universalization of ATM, which has taken many years, has been because it's very simple to use. So the digital studios should be that, and which is what we are working on, and we are more than happy to participate and do our bit. But at scale, we will do that in a very large way.
So Shyam, it was nice talking to you as usual. Thank you for your wonderful insights. Hope to catch up with you soon.
Thank you,
Have a good
sir.
day.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.